Hi, this is Peter Hans, and welcome to Between Two Chains. This week, I'm joined by Arca analyst Nick Hotz as we talk about the valuing of Layer 1 and Layer 2 blockchains, very specifically the ETH merge and what it means going forward, and what we really need to see for this space to take off in terms of new issuance on Ethereum. It's a really interesting conversation. Nick knows he's a wealth of knowledge, and I hope you all enjoy the episode. Remember, this commentary is not intended to be investment advice, investment research, or a recommendation. Please consult your investment professional for your own circumstances. Thanks and enjoy the show. Hi, this is Peter Hans, and welcome to this week's episode of Between Two Chains. I'm joined by Arca's analyst Nick Hotz, who covers Layer 1 and Layer 2 blockchains for the investment team, and I can speak firsthand that he's a really sharp mind when it comes to the asset class and frankly a lot more in the macro world. So Nick, welcome to the show. I think it's your first time. I know we've done some stuff together, but it's your first time on Between Two Chains.
It is my first time. Yeah, appreciate you having me on, Peter. Thanks.
Yeah, absolutely. So, maybe just share a little bit about, your background, because typically it's Jeff, and for the most part, everyone kind of knows what his backstory is. So, love to share a little bit about, some of your credibility, as well.
Yeah, so I've been with Arca since April of 2021, and I was part-time completing an MBA program, and just started up full-time pretty recently. Prior to that, I was working as a global macro analyst at a commercial bank in Minnesota, and so I have a pretty reasonable amount of experience on kind of the global macro side as well, which I think has teed me up pretty well on the layer one side and for how I view layer one blockchains and their valuation.
Perfect. And this is something that we've done at Arca, I guess, a lot of work on in terms of how you approach valuation in tokens, and then more recently and specifically getting into layer ones, which I think is timely post ETH merge. And I know we have another one of the webinars coming up soon. But yeah, you've been pretty vocal, I think, about how even though I guess the underlying layer one is a technology or a platform, more of an infrastructure play, the token itself, does represent a currency, and it's much easier to value it that way, I suppose, than looking at it like equity. Is that fair to us to say?
Yeah, I think that's definitely the case. We've been pretty vocal at Arca about the fact that there are many different asset classes and there's a whole taxonomy of assets here in this within this kind of sub asset class that is digital assets. And one thing we've I think focused particularly on is the kind of quasi equity or pass through token side that a lot of these kind of governance tokens that you see in DeFi or gaming space represent. Where I think potentially we and pretty much the whole market hasn't really differentiated is the idea that layer one tokens and layer two tokens are something fundamentally different than that, and that they look a whole bunch more like a currency than they do an equity.
Like a currency, just because in essence their use case is to pay for transaction fees. I mean, I look at it almost as uh, if I'm using any sort of other payment network, Visa, Mastercard, American Express, and I'm charged an interchange fee on the back end. Well, I guess maybe I am, but the seller is charged an interchange fee on the back end, right? Whether that's passed on the customer or not is varies, I'm sure. But that's obviously paid in dollars on a percentage basis, and here you have I guess goods which can be purchased using ETH or some sort of other wrapped asset that transacts on the blockchain, and then you're using in essence the token for the transaction fee, which would be very analogous, I suppose, to a currency, but one that is only used in that world. Is that a fair analogy?
Yeah, exactly. It's just about metering demand. So you've got all these applications that are built on blockchains, but you need a way to meter demand for the goods and services those applications produce. That's really what the dollar does in the U.S. economy, for example. The other big reason the thing that differentiates this from an equity is that the Ethereum blockchain, for example, issues ETH, the asset, and it's the same asset that it receives in fees and gas fees. There's no company that can issue the dollars that they earn, right? Apple can't issue dollars and then count that as earnings. Apple is producing a product and then it earns dollars, but then has to pay taxes to the U.S. government, for example. So the one entity that can do that, issues that currency that it also pays back, is a government. And so that's why, to me, the representation of a blockchain as kind of a nation or a government, and the L1 token as its currency, makes a lot more sense than kind of the equity like representation.
The metering the metering side of things is interesting, and I'm sorry, I keep going back to to interchange fees, right? Because they're transactional, and those are typically like a very fixed percentage of the item that you're purchasing, right? So the only thing that really matters for the fees of Amex or Visa or Mastercard is the total amount of spend that occurs, right? So the amount of, I guess, bandwidth or internet power is kind of irrelevant, right? Because you can go to dollar store and swipe your debit or credit card 100 times, and it might not add up to one swipe somewhere else. Um, but ETH, I guess, is a little. I guess it's different in the underlying technology, obviously, but it's also different in that it's almost like Uber surge pricing, right? When the network is busy, the fees are higher, and when the network isn't as busy, the fees are lower. Is that
Yeah, that's absolutely right. I think of Ethereum as kind of like, you could analogize it to a public park, right? If everybody wants to go to the park, that reduces the value to the incremental person, right? Because it's too crowded and not everybody's going to enjoy it as much if another person comes. But if the park's empty, one person can get a lot, infinite, or the maximum amount of enjoyment from that park by coming on. So the fees in that case, when there's just one person coming to the park, can be low because it's not having any sort of uh, tragedy of the commons issue with the public good being overtaken, too many people wanting to use it. But as more people want to use it, you need a way to meter that demand to make sure that the park doesn't get overcrowded and reduces everybody's experience. And in the case of Ethereum, that is, there's too many people who want to demand using space on the blockchain to execute computation, and there's just not enough computation available, because that
right?
would make the validators, the people who are actually running the chain, have to work much harder, and that's really bad for the decentralization aspect of the
It's,
network.
yeah, it's actually a really good analogy, like park or restaurant or bar, right? But, also you need some sort of equilibrium, right? Because you can go to an empty park, but it's kind of like creepy or not that desirable to be walking around a park by yourself. You kind of need some sort of balance of having people there, but it not being too crowded. Um, Interesting. So then let's talk about and I think all this stuff is obviously like relatively basic in terms of how it operates, and then you get to the valuation of the actual Ethereum token, which is very very different. Um, and then I think the other kind of wrinkle is how has the switch to proof of stake changed the dynamics of transaction fees and the amount of transactions that can be which I guess is related to the transaction fees, right? If you can process more transactions quicker, then you can lower fees because there is no you know centralized entity um, you know actively setting price, right? It is truly set by supply and demand.
Yeah, that's absolutely right.
So when I think about the merge or the switch to proof of stake, how is pricing going to work going forward?
Yeah, so I think this is a common misconception about the merge. The merge doesn't actually affect the kind of transaction fees or the amount of data that Ethereum can process. It's really not about scalability. What the merge was about mainly is, one, enhancing ETH as an asset, and two, making the kind of environmental switch away from proof of work
Hmm.
to increase the energy efficiency.
Right.
So,
Okay.
the main thing we see as far as ETH asset is that the proof of stake is a much more efficient from an economic standpoint mechanism than proof of work is. So the amount of ETH that needs to be issued every day to pay validators to run the network goes down by something like 80, almost 90%. And so what that does is means that the amount of inflation that you have on Ethereum, the network, the amount of tokens being issued reduces very significantly. And when
Right.
you think about, ETH as a currency, a more inflated currency should be worth less than a less inflated currency.
Of course. Of course. So you talk about the misconception then, because I was always under the impression that transaction costs would go down, and like they have to in a lot of ways, just because I've looked at things to whether it's NFTs or anything, right? And you're sometimes you're paying like a third of the price of what you're buying, or 100% of the price of what you want to buy in transaction fees, which is like it makes no sense. And I know that's where layer twos can come in, and you have things like Polygon, which are fractions of a penny. But is there anything that you think over time will take down transaction fees on Ethereum, or is it really just side chains?
No, absolutely. I think that the misconception came from originally the idea was that Ethereum 2.0 was supposed to be this kind of whole package of upgrades that part of it was about doing the merge switch to proof of stake and part of
Hmm.
it was about scaling, and they kind of moved away from that narrative. Now they're putting kind of a different spin on the roadmap. um,
What was it?
but
Sorry, was it a
I will say
narrative or
the
was it
last two
real?
major uh, yeah, no, I mean, it was real. The roadmap over the last 2 years was really focused on enhancing ETH as an asset. So the burning from EIP 1559 and then
Yep,
the merge. Going forward, the roadmap is entirely about scalability.
got it. Okay, okay. So
So
it's just a change in
the
the
next
deployment
upgrade
schedule.
that will probably come, yeah, yeah. So the next upgrade that will probably come with the withdrawals of ETH from the staking contract will be all about basically reducing the cost of moving to layer twos,
Mm.
making layer twos even cheaper to transact on, and trying to push those users off of Ethereum mainnet towards layer twos.
Hmm. I mean, right. So is that really just about the cost of transferring the assets from, because right now if I have ETH and I want to transfer it to like purple ETH on Polygon, I go to any sort of service and do that transfer, and there's a transaction cost every time I switch back and forth and back and forth. So it's about decreasing the friction and cost of those switches essentially.
No, I misspoke there. I suppose it's about decreasing the cost of every transaction on layer two. So if you bridge to Optimism, which is a optimistic rollup on
Uh-huh.
Ethereum layer two, uh, that the fee that Optimism pays to Ethereum to secure itself gets reduced. If you though then go transact on Uniswap using Optimism rather than Ethereum, that cost would be reduced, and everything that you would do on the layer two network will be cheaper. I mean, it's already much cheaper than Ethereum, but it will be even cheaper after these upgrades going forward. And this is really the roadmap that Vitalik has presented, the founder of Ethereum,
Hmm.
that we want to move people towards the layer twos off of the mainnet.
Got it. Um, Interesting. Okay, and then so when we and others talk about kind of these multi-chain worlds, in your mind, is that multiple layer twos all interacting with Ethereum and there will be one winner, or is it truly kind of multiple layer ones, potentially multiple layer twos, and we'll have ways in which Solana to ETH conversions can happen, or something along those lines?
Yeah, it's a really interesting question. I don't think anybody has a super firm grasp, but my best intuition is that Ethereum will not be the only ecosystem. I think that's pretty clear at this point. There will be other ecosystems that emerge, And what really gives them a moat is a security that they provide to the network, because you can these various layer twos can compete on a whole bunch of different things, just like a normal company can compete. They can compete on branding, on culture, on the applications that they host, on the fees, on everything in that space. But what a layer one really is doing, in my view, is just providing security to those things. And anything, if you're trying to compete on something other than that, you're really you're providing something fundamentally different that could just be optimized best as a layer two, because you're paying more for security by not having that optimal kind of security system if you're trying to compete on applications or something like that. But I don't think it's going to be an entirely economically efficient where everything rolls up to the top
Hmm.
staking vehicle, i.e., Ethereum currently. But you probably have a pretty big narrowing of the selection. And then the way I think it probably breaks down is that you have layer twos on top of these major security providing chains. And then even beyond that, there have been talks about layer threes. So more application specific. So, i.e., a single application having its own blockchain that's built on a layer two. So then compressing all their transactions and reducing fees to there. And then the layer two is bundling all of the different applications that have separate blockchains and sending it back to the layer one. So you still get that great security that you get from this, very, very credible layer one at much, much reduced fees.
Oh, so that's what I was going to ask. So when you start talking about side chains, right? I would imagine that, I know in many cases we've seen over the past year or so, it's opened up, a lot of security concerns. But in these cases, you're saying that ultimately you're piggybacking off the security of the Ethereum blockchain, and you don't have to worry about, XYZ side chain getting hacked.
Exactly. So yeah, I think side chains will probably not be as relevant in the future, and I think a lot of the side chain creation, or the teams that have created side chains in the past, have generally pivoted towards other types of layer twos, namely rollups, which are secured by the layer one. You get most of the same benefits of having a side chain, but you also get that security.
Got it. Okay, I guess just for the audience, differentiate for me the difference between like a layer two and a side chain.
Yeah, I mean, it's really just terminology. There isn't really a specific definition between either. Where there is a distinction is between a sidechain and a rollup. So a sidechain is just like a separate layer one blockchain. Really, it has its own security system. It has its own validator
I
set
gotcha.
and people who secure the network. Whereas a rollup does not have that. It outsources it to a layer one.
I gotcha. Okay, that makes sense. That makes sense. Which is why when you see these kind of side chains hacked, you might deposit ETH. They'll have some sort of wrapped ETH. If that side chain gets drained, the actual ETH gets drained. The wrapped ETH is still there, so the person's balance will be the same, but they own an asset that's now no longer backed by anything of value.
Yeah, yeah. Whereas you would have to compromise if you're a roll up on Ethereum, you'd have to compromise the Ethereum security in order to be able to do something like that on a roll up.
Perfect. Okay. Yeah, that completely makes sense. So let's then transition to kind of like the main topic, right? So I think it's pretty evident that as of right now, at least, Ethereum is kind of the dominant blockchain in terms of um, you know credible use cases, transaction fees. Now, I would also argue that like we're nowhere near the amount of real world use cases that we need and that we'll probably have in 10 years. But right now it's a very, very clear market leader. I think I see in kind of some of your notes here, like they've generated in Q2 about over $635 million worth in basically earnings, and we can get into exactly kind of like what that means. Um, but if I'm an investor and I want to have exposure to quote unquote, blockchain and there's no like equity per se I can buy that allows me to own the infrastructure. It's not like the mid 90s I can't go buy EMC stock, right? So you can own ETH, right? But ETH is the currency used on the network. In many ways, it is a more overt call option on the growth of the network, right? Because in essence, the more activity that occurs on ETH, the more demand there is for ETH to pay fees, and it's just pure supply and demand. But I think with the merge, right, there's also a yield component to that, where now you can actually either overtly stake your ETH if you stake what 32 plus something around that, or if you have it in Coinbase or so,
32,
they're
yeah.
basically pooling all the ETH to stake it. So um, yeah, maybe just take a look at ETH as an asset, right? How you would value it and how you would differentiate it from um, I guess a traditional like an EMC or an Apple or a traditional equity, right?
Yeah, yeah. So again, going back to kind of the idea that these layer ones are currencies rather than equities. You can say, we can look at Ethereum, and when I'm talking about earnings, or what you're looking at there, what I'm talking about is ETH burned. So Ethereum has had an upgrade just over a year ago, or yeah, just over a year ago, that established a certain proportion of the fees being burned whenever they get paid by users. And so that is reducing the supply of ETH. Now, that isn't truly earnings, right? Because what we really need to see is an offset of new supply coming online in order to change the pricing dynamic. So if say 4% of the circulating supply of ETH is getting burned every year, but that's being offset by 4% being issued. Net net, that has no effect on the price of ETH. Supply, the merge was important because it reduced that supply by the new issuance by quite a bit, like I said, almost 90%. And it also incentivizes people to lock up ETH to stake. So you're
Hmm.
reducing kind of the amount circulating available. So if there is net new buyers, there's less liquidity there in the markets in order to purchase that ETH. I mean, you could say the same thing on the downside, obviously. Uh, what I think is pretty inarguably more important, and I think the market does recognize this, is the demand side. We can make arguments about 4% new supply versus 0% new supply. If 10x new users come and use this space, that's going to be way more impactful than the discussions over 4% new supply. So while the merge was definitely impactful, what really is the main driver here is the demand side.
Absolutely. No, no. So that completely makes sense, right? If there are more Ethereum-based wallets, more transactions, more quote unquote like things to do of value that are not just trading crap back and forth. Um, that's it's a demand side story. Your definition of earnings is interesting. Like so, okay, because I would think, or so if I looked at this as just like an income statement, right? And I would think about the revenue is in essence the transaction fees that ETH generates, right? Now, a certain percentage of those fees are used to burn ETH, right? Which was 1559. So your earnings calculation based on dollars of ETH burnt is actually a fraction of the actual transactional fees that ETH is generating, right? Is that the right?
Yeah, it's about 80%. If you're again, I wouldn't look at this as an equity, but if you did, it would be about an 80% margin.
Well, yeah, no, I'm not looking at it as an equity, but if you want a proxy for the demand growth, right? The transactional fees generated on the platform is a proxy for growth in demand. Now you could say ETH burned if it's kind of, you know 80% of transactions, then it doesn't really matter because it's just a ratio, right? Um, and then you're offsetting it by, in essence, the new supply, which is in essence the yield being generated to those people who stake, right?
Yeah, yeah,
Okay.
exactly. So there is a small amount of issuance still. I think it's about a 0.5% per year that is issued, but the rest of the yield is coming from the part of the fees that are not burned. So that's other 20% ish, say.
Which is,
And tying it back into the kind of currency idea, right? Like the important part here is that as demand grows, because there are fees that need to be paid in ETH, that means that people need to demand ETH to pay those fees. On another blockchain where the fees are, in the tenths of cents or something like that, even if the number of users on that blockchain grows, the amount of fees paid are still negligible, right? And the demand, unless you create it into some sort of medium of exchange in another way, for example, a pair with NFTs or kind of a base asset in DeFi, it really isn't, it doesn't become a valuable asset just because there's more people using the blockchain. You really need to establish the asset as a kind of core part of the ecosystem.
yeah,
And
no,
I
and
think
that,
Ethereum is a good example of that.
which basically means that transaction fees have to be a certain amount, right? Just to warn. I mean, look, I use Polygon, not a lot, but a fair amount. But I've had $5 of Matic sitting in my wallet for over a year, and it, like, doesn't dent
Yeah.
it, because it's a fraction of a penny every time you transact, which always made me think, like, well, why would the Matic token ever go up unless it's just pure speculation? It's not going to be based on market dynamics, unless I'm totally missing something there.
No, I mean I think you've got it exactly right. I think Matic is an interesting case where they've kind of got this whole suite of rollups that they're looking at launching, and I think the Matic token will probably be the way that you pay for those as well. So it's
Mhm.
really kind of the market being optimistic about the future of their ability to develop the rollups. But yeah, certainly given the existing Polygon chain, there's absolutely no way that thing could have a billion users and it wouldn't be able to justify the valuation that Polygon has today.
So okay, so let's talk about valuation then. All right, so so let's talk about ETH, right? It's a little funny, right? Because all right, there's the amount of ETH burned, which is based on a percentage of the transaction fees, and the and then the new issuance and revenue, which is the dividend in essence paid to the stakers, is also paid out in ETH. Um, so you are burning supply, increasing supply in the same base currency, let's call it. Um, what's like a, do you look at it, is there a multiple that makes sense? Like, how do you think about valuing that? I know how to value other assets, and then currencies. I mean, I'm not a macro guy, but they could be relative to each other. There's different ways to look at currencies. Like, how do you personally look at ETH? What makes sense to you?
Yeah, so a couple of years ago, I tried to build an Ethereum model based on the fees and trying to think about like, okay, what are the earnings going forward based on these fees? And very quickly you realize it's just hopelessly reflexive, right? Because if the price of ETH goes up, the amount of fees generated in dollar terms goes up
Hmm.
exponentially, reflexively tied to that model. So that's what really got me on the road to thinking about this as a currency. And I think you have to value it the same way, which means that you really can't create a kind of fundamental valuation model based on cash flows for these assets. You really have to just think about how do you value a currency? A currency is valued on a relative basis against other currencies, or other assets. And that value is tied to the amount of demand for the currency. For example, like if you think the US economy is going to outperform, the dollar might go up. Or if more people are going to use the dollar for pricing oil contracts, it might go up. The supply of that currency, which is going to be on the margin, how much inflation of the dollar is there? and the relative interest rates across the board. So if the dollar is yielding more than the euro, for example, all else equal, you expect that the dollar will rise in the future relative to the euro, to kind of reach parity in terms of those interest rates.
Hmm.
And so
So do you?
with going into ETH, for example, right? Like what you went from is essentially a really a negative yield because you were issuing ETH at a 4 or 5% per year, and you were not getting compensated for that. To now, after staking, you've got proof of stake along with the burn. You're talking about a real yield, i.e., like yield after inflation, of something like 4%. So you've gone from a very negative yield to a very positive yield. And thinking about that relative to a lot of other L1 tokens, they're yielding, whatever, 5 to 10%, but it's all coming out of inflation. So the real yield difference that Ethereum has relative to these other currencies as a direct result of the merge, has gone up a lot. All else equal, you would expect capital to flow into ETH to get that yield, and have further currency valuations to adjust accordingly.
Right, and I guess unlike so a couple things here. So unlike a a dividend, a stock that pays a dividend on which calculates into a percentage based on the stock price, and as the stock price goes up, assuming the earnings of the company stay the same, right, the dividend rate falls. In ETH terms, um, ETH could go up in price, and the dividend can go up in price in percentage terms simultaneously, dependent on the transaction volume in the network. Is that is that accurate?
Yeah, I mean it's all denominated in ETH, right? So if ETH goes from whatever 2,000 to 3,000, the amount of ETH being paid out by the network, as long as transaction volumes are the same in ETH terms, does not change. So the staking yield could be unchanged at 4%,
Oh, okay. I
regardless
see what you're
of
saying. Yeah, because
ETH's price.
it's all in ETH terms. It's all in ETH terms. Yeah,
It's all denominated in ETH, exactly.
that does make sense. Yeah, that's a still even now it's a tough thing to like kind of wrap your head around all the time. Interesting.
Yep.
Okay. And then I guess in other assets where you say like all of the staking is inflationary and the yield is inflationary, and yeah, in a recent episode, I think actually the most recent episode of or two ago, I asked the guest kind of like it was kind of a metaverse Web3 gaming person, like I just don't understand staking in most cases. Like you just like what's the value of staking for the issuer, right? Just like who cares if the tokens are locked up and then you just get more out and it's just inflationary and you sell. Like it doesn't seem to add any economic value, which I still don't understand. But in ETH sense, obviously, um, the staking is what is used to secure the network, which I'm not going to pretend to fully understand. And the reward for in essence locking up your ETH is the yield of the transaction fees, and you can either in essence reinvest those dividends or liquidate those dividends. Is that a
Yeah,
fair
yeah, that's
take?
exactly right.
Okay. And what do
Yeah,
you think
yeah,
most people
and
do who
getting back
stake?
to like the sorry, what do you mean?
Meaning, do you think because when you talk about the inflationary aspect of the yield, right, that's paid out, it's not inflationary in practice if everyone just continues to stake, right? If the staked amount of ETH increases by, I would imagine, some percentage of the inflation, right? Because the amount of ETH
Yeah,
paid
I guess
out is,
in comparison to another chain that is entirely inflationary, and say has minimal fees, right? You are incentivized to stake because you're essentially holding your head above water. If there's new issuance coming online of 20% per year, you if you aren't staking are getting inflated away. Your value is getting inflated away at that same rate. Whereas if there's a real yield above and beyond inflation in the case as there is in the case of Ethereum, uh, yes, you're still incentivized to stake, but it's more like a reward for payment of of providing security for the network rather than an incentive to kind of keep yourself above water.
No, yeah, and I totally get the rationale for someone staking. In the other scenarios, it was more the rationale for the issuer of the token to value staking. But it's I guess it's just to get tokens in people's hands.
Yeah, I mean, it's certainly it's different for a layer one relative to some of the kind of more metaverse gaming
Yep, totally.
applications that you might have had mentioned. Like with the layer one, yeah, there is real value to kind of the security provided by validators, and that is needed to decentralize and secure the network. In a lot of cases, I think with these metaverse and gaming tokens, it's more about reducing the velocity of the token circulating, right? It's about making sure people are incentivized to lock their tokens up rather than to sell them.
Yep, no, that definitely makes sense. Okay, so if you're thinking, so when you look at ETH now, and if the model, in essence, doesn't work, or at least is reflexive to the point of, um, looking for alternative ways of valuing it, um, and they're, it's not as easy. It's not, I shouldn't say it's easy, but it's not like I can look at the dollar and I can look compare it to the pound, the euro, the yen, Swiss franc, whatever. With ETH, what are you comparing it to?
I mean, all of those, right? I'm primarily other crypto assets and to the dollar. You really valuing it then is really just about thinking of kind of the forward supply and demand and what the relative net issuance of tokens and net adoption of ETH as an asset looks like. So, like I said, the supply side is a component, yes, but it's a very small component relative to the demand side at this point.
Hmm.
It's kind of like with Bitcoin, where the early on halvings, when you're reducing inflation from 50% to 25%, that's a lot more impactful than nowadays, where you're reducing it from, what is it, 2.5% to 1.2%. Even in terms of like total value, it's really not that impactful. So you really just have to make some, assumptions about and forecasts about what the future of the first of all of digital assets look like. Is how big is the pie of total digital assets, and how does the kind of how does the business model break out, right? What does the marketplace look like? Is it 80% of the competition is owned by one protocol, or is it kind of more equally distributed, like you said, with this kind of multi-chain thesis where all these different layer ones are competing and much more on equal footing? And once you get those two uh, those two down, then you have to think about the relative comparisons in terms of technology, of security, of uh, you know adoption and business what do you call it? People using the chain and the chain bringing on new applications and businesses into
Use
it.
cases, yeah.
Uh, and all those things will determine kind of the relative valuation that you get on these different layer ones.
Are there other layer ones outside of ETH right now that you think are interesting from the standpoint of um, potential future demand growth?
Yeah, it is really interesting. I mean, I think there's very different approaches that a lot of them have gone for, and I think all of them have pretty. A lot of them have pretty good cases on the demand side, and then they may have some issues with the tokenomics side. A good example here is Atom, so Cosmos's ecosystem token. Cosmos has been growing the number of blockchains on it very, very rapidly.
Hmm.
They have a very different model than Ethereum does, where They believe all of these different chains should be kind of exist in parallel and be sovereign. So each of them is providing security for themselves currently. And so the Atom token, which secures the kind of main Cosmos chain, isn't really integrated with the rest of the ecosystem. There's actually another chain called Osmosis within Cosmos that is more liquid, has more transactions, has more pairs with the other blockchains in the network. And so the question a lot of analysts have had is, how does Atom accrue value if this is kind of the path forward? They had a recent conference where they introduced a new roadmap to kind of revamp Atom as a token and try to push this narrative. It remains to be seen whether that is kind of accepted by the market as kind of the way forward.
Yeah, they've had a pretty remarkable bounce back in a short amount of time. Cosmos, right? Because I mean, there was a very large portion of their um, of their business was tied to Luna, right? Luna ecosystem,
Yeah. Mm-hmm.
and they were somewhat left for dead just a few months ago. So yeah, that's pretty remarkable staying power there. Um, interesting, interesting. So I guess ahead of this this kind of next webinar you're doing, um, anything else you want to point out as it pertains to either ETH specifically or thinking about the entire ecosystem of layer ones?
Yeah, I recently did a post actually yesterday on the block space cycle, and so what I was doing there was comparing again, kind of using the same framework with layer one tokens as currencies and blockchains as nations, and thinking about the differences and the comparisons between what the cycles look like in the blockchain world with the business cycle. So the business cycle is how growth and inflation and policy action impacts the economy and impacts asset prices, uh, and that's all driven by credit in the economy. The government can increase and decrease the supply of credit, and the market also is responsible for kind of determining how much credit is offered. I think that the relevant comparison here is block space, which is kind of what we were hinting at earlier. It's space available on the blockchain that is of limited supply. Just right, you can't have everybody go to the park at the same time. And the thinking about like what we had in the last cycle, if you want to define it as that, we had increasing usage in going into 2020, and all of these applications that increasingly use more and more computational power. So you had sending ETH transactions takes less than sending a DeFi transaction, which takes less than yield farming, which takes less than NFT minting. And so more and more these applications got hungry for block space. And then come 2021, you had gas fees really, really high, and suddenly a huge demand for more block space to be able to replicate these applications everywhere. And you got this massive bid for other providers of block space, Solana, BNB, Matic, or Polygon, Near, all of these different providers that said, okay, hey, we know block space is really expensive on Ethereum right now. We've got some too. And now rolling into 2022, those applications are not highly demanded. The cost of block space or gas fees have gone way down, and so I think you're setting up for an environment now where these L1s and their currencies essentially are not accruing a ton of value from the applications. There's not a whole bunch of demand to use applications right now, and you've got still a backlog of all these different chains who wanted to start up in 2021 because they saw how much value there was in block space, coming online in the next 2 months, or sorry, not 2 months, 12 months. Tons of roll-ups, new L1s, all sorts of upgrades coming online that are going to increase scalability. And so I think you've got this environment where you could have fees hold really low for quite a while, even if you get a pickup in demand and some new applications coming online. And I really think it favors the kind of application sector over the layer one sector, where layer one has been such a favorable place to be over the last 2 years.
Well, a lot of that too is also, I mean, as I look at it, right? We overuse the word nascent, but like we're still very early in the sense that if this entire thesis of kind of blockchain based world and digital asset derived world is going to be true, you are going to see probably hundreds and thousands of use cases be built and delivered upon blockchain, both from existing businesses and businesses that don't exist yet. Whereas everything up until then has really just been like, how do I buy a call option on this future, right? Which you can only really represent
Yeah.
via ETH. But so is that so? I guess in your mind, I think are you what do you think needs to happen to get these real use cases? And I understand there's an element of like a lack of patience, right? This is still pretty young, and there's still tons of question marks around a lot of different things. But what do you think? Predict the future a little bit for me.
Yeah, I mean, I think that there's a there's a pretty consistent technological adoption cycle where you need to build out infrastructure before you can have the applications built on top of it, right? Nobody could have imagined Facebook prior to the build out of like broadband and general usage of the internet or even personal computers in people's households, right? So personal computers at the time were seen as kind of a fad or like a I mean, I guess I wasn't there, but like at least a very specific niche used for niche things, right? Talking to your friends online or sending an email or going to a message board or something. And I don't think people imagined at the time all of the different applications that could be enabled by that infrastructure. And that's the point where you're at right now, where the infrastructure is seeing a ton of innovation and you're seeing, like I said, a ton of block space coming online. The cost of using these is coming down exponentially. What you haven't seen as much is the applications being built out. And I think that's a function of it's really hard to build an application when people are paying $50 for a transaction on Ethereum as they were
Hmm.
in 2021. So,
That's a good point.
I
Yeah.
think this is a pretty consistent cycle. This usually happens where infrastructure costs fall over, a few decade or 2 decades or something. And as they fall, applications start to come online and you really see the consumer applications and the real adoption of it start to happen afterwards.
Yeah, I think those are actually really, really good points. Yeah, I mean, being in it every day, you kind of, you can lose the forest of the trees in terms of, you do have to have like a more robust infrastructure, and we just probably aren't there yet to, an infrastructure could mean a lot of things. There's a little bit of a chicken and egg thing, right? Like how do you get wallets in people's hands and stuff like that, right? It's why I always think things like, a digital US dollar, like a more overt USDC would be like probably one of the most beneficial things for Ethereum and the blockchain space in general, just because you'd onboard like what billion, maybe a billion, but certainly a couple hundred million users.
Mm-hmm.
So yeah, it's definitely interesting. Well, cool. Well, look, Nick, I appreciate you joining me, and is obvious a lot about this space, and I'm looking forward to doing the webinar with you and getting more involved as well. So appreciate it.
Yeah, no, absolutely. I appreciate the time today, Peter.
All right, cool. All right, thanks, Nick. Take care.